Hello, it's Tim Moffat here from Oakley Investment Management. I'm again sitting with Cal Patel from Property Share Market Economics, one of our investment committee members. It feels a lot like I'm in Adelaide, and it's feeling a lot like I'm in London at the moment. It's pouring with rain outside and very cold, so not particularly enjoying that. But anyway, thank you for joining us again, Akil. I'll just do a quick usual rundown on the portfolio and then talk about a few comments on the market and things we're seeing. The 18.6 trading portfolio finished last financial year in Australia, ending 30 June with a bit over 22% return, ahead of the world MSCI World Index of about 15% up for the year. The portfolio last quarter had pretty high cash levels early in the quarter. We built the cash levels up towards the end of March, and then as the market deteriorated on President Trump's tariff confusion, the cash levels got up to about 30%. And so the focus on capital preservation has definitely increased as we've kind of moved later and deeper into the cycle. The cash levels did come down towards the back end of the quarter and ended at about 14%. So what that meant was the portfolio experienced less downside volatility, but also underperformed the index on the bounce back, obviously, given the higher cash levels. So overall, we're still positioned for continued upside through 2025. In terms of sectors, we are positioned towards those we've talked about in the past, but that typically perform strongly in the back end of the real estate cycle. Things like emerging markets, resources, in particular copper and gold, and the fire sector, so finance, insurance, and real estate. In regards to, I guess, market commentary since we last sat down and spoke, it was actually interesting when the US bounced back very strongly, and a lot of that buying looks like actually retail buying rather than professionals and funds. It looks like the fundies basically sit on the sidelines, not really believing the bounce back, and a lot of it's been retail buying. So I think that's just interesting from the perspective that retail money does tend to get more involved in the market towards the end of a bull run. There's certainly lots of articles flying around in regards to, in the US, like penny stock volumes are at record highs. Interest in leveraged ETFs and leveraged stock ETFs are growing strongly. So I think that's just a red flag, an initial thing that we're watching, and another little maybe minor red flag that we're seeing. In terms of retail, the professionals or the fundies missing the market, I think that probably is interesting from the perspective of potentially gives more tailwind credence to a stronger second half. There's only so long that they can sit out of the market. So if we do see that the market continue to sort of tick higher, I think that some of that buying could be coming from that professional space. The other thing of interest is on a 5-year or 60-month repeat, the market's pretty highly correlated in terms of falls into March and recovery thereafter with 5 years ago or 60 months ago. So that's an interesting point to note. And I think if you overlay that with the PSE roadmap, if you continue that correlation through the rest of the year, that probably looks like that'll line up closely as well. So I think that's another point of interest. Last night we saw copper price go up 10%. The copper price has been building in the background, making higher lows steadily and slowly, and it just popped on some tariff announcement. Interesting, the market didn't really know what to do with that today. Some stocks up a bit, some stocks down quite a lot. I think that probably makes sense in the short term. People trying to figure out exactly what that means for companies, copper producers inside and outside of the US. But overall, I think that looks like a very strong technical break. So we'll be watching that pretty closely, and we do have a reasonable exposure there. And then a few other points to note. There's a couple of little red flags from a cycle perspective, and maybe you can comment on these a little bit deeper, Akil. But it looks like the US Home Builders Index has formed some sort of a topping pattern. Certainly has weakened in the first half of this year against the broader market. If you look back in the past, that did peak 18, 24 months before the rest of the market in 2006-7. So that's a little red flag that we've been watching for that does look like it may have occurred. Similar sort of thing for the US insurers index. Probably not a confirmed top, but that sector topped early last cycle as well, and it's certainly started to flatten out versus the stock market or the US market in the last few months. And then finally, you've just seen the first down month in US property prices if you're looking at the FHFA house price index. So while 1 month a trend does not make, it's certainly something that we're watching pretty closely across other data sets as well. I'll shoot, maybe you want to comment a little bit more on that, Akil, but it seems to have lost a bit of momentum from a property price increase in the US.
Yeah, okay. Maybe start with that. Look, I think the reality is that housing markets across the world, or at least the Western world, have had a pretty interesting couple of years, to say the least. As soon as interest rates went from record lows to not record highs, but the speed of the move up was, I think fairly unprecedented levels. And there was sort of widespread concern that this was going to kill the housing market, and it didn't. I think there's been quite a lot of confusion, but nonetheless, in a lot of places where prices were simply too unaffordable and reliant on very low levels of interest rates for people to access the sufficient debt servicing to cover mortgage payments and so on, that prices have come down. But overall, I think we've seen that house prices have continued to move up more or less uniformly across countries. Within countries, it's been a bit sort of more mixed. I think what we're seeing in the US is that sort of mixture is starting to spread out a bit. So you've had some big markets like Florida, for example, where you had higher house prices, but buyers not willing to meet that level of asking price, sellers not willing to reduce that price, and so the net result was that the volume of activity was slowing down. Maybe what we're seeing now in some places, assuming that sort of trend is replicated in other regional markets in the US, maybe what we're seeing is that sellers are now starting to reduce their asking prices somewhat. But again, you can't tell that from one monthly data print. So we'll watch that. But we are potentially seeing the start of a slowdown. And I think the great thing about our framework and the roadmap and so on is that we have things that we're looking out for potential kind of issues ahead, and then position our portfolio accordingly.
Yeah, no, that's great. Thank you. Okay. Is there anything else from a macro or market perspective you thought worth touching on?
Yeah, I think, some of the sentiment is not particularly bullish at the moment, it has to be said. I mean, I'm not talking necessarily about tariffs. I think maybe some of that is priced in to the market. There's a lot of geopolitical uncertainty. Some of that is priced into the markets. I think, there are a number of people who I think have relatively, for whatever reasons, valuations are very high in the US stock market. You have, somewhat uncertain outlook in China. I know there is some stimulus going in to prop up the Chinese real estate markets, but there's still some uncertainty and so on. I think some sentiment is relatively bearish, and I just caution against thinking that we're at the actual sort of final peak of the cycle. I think that the challenge of the next sort of year or so potentially is how to navigate what still might be a bull market, but with plenty of red flags, as you said earlier. So to take advantage of the upside but being careful about the potential for a downside. And I think, again, I've said this before when we've had a conversation, having our framework is quite important to be able to sort of, navigate both, parts of that equation, both the upside potential, but also the potential for a peaking of the cycle to come about. So it's going to be interesting times, but I think we're sort of well set up for all of the, as you've pointed out, the components of the stock market that should do well at this point of the cycle. So we've got sort of some credit exposure with the sort of banking exposure. We've got commodities. We've got emerging markets. So now these are all somewhat linked to the falling dollar. So we're sort of taking advantage of that kind of move as well. And so, yeah, I think it's looking sort of fairly promising at the moment. Let's see what the next quarter will bring.
Yeah, so just tying that back to the portfolio again is, we were definitely quicker this year, being sort of later in the cycle with our cyclical holdings when the market rolled over to exit, lock-in positions or exit positions that were non-performers. So I suspect, if we're right in our assessment and markets do continue to kind of climb the wall of worry and grind higher, we're just looking to get more aggressive with that type of behaviour in terms of pulling capital out of the market should things deteriorate unexpectedly, knowing that in the background, I guess, the economy and the markets are becoming ever more fragile as they grind higher.
Indeed.
Yeah. Awesome. All right. Well, let's, in the interest of keeping it short and sweet, let's leave that there and hopefully come back shortly with some more commentary. Thanks for your time, Kim.
Thank you.